My friend, welcome to today's video. Today I will explain one of the biggest edges which I have had in the past couple of years of trading. And using this methodology, I have generated most of my returns in the past 4 years. I'm gonna explain in depth how to use it. So let me jump into trading view, and right before I begin explaining this, I want to recommend you 3 things. In the bio of this video, in the description, you're gonna find a link first to a 2-hour bootcamp, which is absolutely free. You don't need to pay anything. Second, you're gonna find a link which is affiliated to BloFin. It's a non-KYC exchange. So if you're looking to sign up to an exchange which does not require you to do a KYC verification, BloFin is the place. Third thing which you want to look at is the free Telegram and the Discord, of course. And also, if you want to join the networkers, well, that's a separate paid feature. Everything else is free. So let's jump into it, right? So this is the trading view chart, and we're gonna take a look at specifically what happens when we exchange from London to New York. So the thing which I want you to pay attention to is, first of all, you need to be aware of that you have 3 different sessions primarily during the day. So let me just show you a thread from my Discord, which I have explained it, how I view each trading session. And I'm gonna read it, so let's get this first, okay? Let's get this clean out of the way. Session times as follows, UTC time. So first you have Asia from 12 to 6, London is 6 till 12, New York from 12 until 8, and the close from 8 until 12. So typically during Asia, typically at the charts, just as session closes, I observe 3 things that occurred in the session. First, the initial balance. Second, any buying or selling tails. 3, where the daily open is relative to price. This is about Asia, and what I mean by this is, let's say right here. So you have the daily open, 1 o'clock. Right here, have the price move up. It creates a selling tail and then it moves away. So this is something that I do observe. The initial balance is formed until 2 o'clock, which primarily in this case is a bit more bearish. It's a bit more wide. Now, second, London tend to stay out of opening trades unless an ideal scenario occurs. In this time, I would, do my routine analysis. I would observe price, and I would check if any events occur that could cause volatility during the day to stay away from. And during New York, this is why I do most of my trades. So in a good scenario, if London has formed a daily pivot or not, I would look to fade that. And the other thing, I would watch to see price. If a level of interest is reached out or not, then I would look at the order flow for reactions and execution. And during the close session, typically, you have slow PA, and I do remain awake in that time, and I do plan for the next morning. And the other thing is, any trades taken during the day will be journaled, notes, and if any changes can be done, I will do them. And things to take away, I've gotten to a point where my trading plan has become more efficient enough, where I have structured a day and I know exactly what I'm looking for during my trades. Thousands of hours of research and statistical info helps me build that. Okay, so let me just jump into the first. Actually, it is the most important thing, not just the first one, it's the most important thing. So I do call this the New York sell program, yeah? So I do call this a market maker model because it's a very repeatable pattern. A market maker, to get this straight out of the woods, first of all, it can be an entity. Second of all, it can be something physical. It can be a fund, doesn't matter. It can be anything. I would call this an entity with lots of capital. So here's my explanation. So in this scenario, you can clearly see you have Asia moving down, a bearish initial bounce. Then you have the initial closing of the Asia session pushing up, and then London forming a range, creating a high, a higher low compared to these two, and another higher low. So pretty much all these sessions, the boundaries, you have a low which is not taken, you have a low which is not taken, you have a low which is not taken, and you just swap the highs. And also to note, this first high, this is a repeatable pattern. The first high is actually not the high of the session. Why? Because it's before the official open of the New York session, which is actually 2:30, not 12. Just I do make the session start at 12, but the official open of the New York Stock Exchange is at 2:30. So this is an example of how it looks like. You have lows which are not being swept. E.g., you have lots of liquidity being left over here, and also to keep in mind that you do have the previous day low there as well. So over here, and you're coming from a very big impulse down. Now, this is the way it, let me just see. Yeah, that's another example. It's not the same example, that's a different example. I just want to show you that you have a similar thing, but vice versa. You have a high which is not taken, a high which is not taken, and a high which is not taken. Asia high, London high, not swept. So liquidity is gonna be there, and if price continues to move down, it's gonna want to take that liquidity before it continues in the direction it's going to. Okay, so this is the way the order flow looks. This is about, I believe, the first scenario. We're talking about this one. I'm gonna jump into the order flow. So pretty much that's the way it looks, yeah. So in this situation, you have trapped longs at highs, trapped value area, you have a spike in the volume, the delta, you have an increase in the open interest due to lots of longs opening, anticipating a breakout, okay? And later on you do form like a mini bearish CVD. So in this situation, this is the way it looks. So you see this increase in the open interest, that's because of the longs coming in. You can also clearly see the spike in the delta, spike in the delta, spike in the delta, and you do clearly see the first volume spike and then the second one. And here you can see at the top the buying imbalances and the kind of trapped value area over here. So it's not the most perfect scenario. Keep in mind that that's on the 15 minute. On the 5 minutes it's even more clearer, but on the 15 minute that's the way it looks like. So over here, this is on the 1 minute chart. So this is the mini bearish CVD, and this is the spike in the volume in the delta which I'm talking about, and this is the increase in the open interest, yeah. So keep in mind that this is pretty much at the open of the New York session, and then later on when you do form this bearish CVD, it's at 244 and the open is at 230, which pretty much marks the high. So I did enter at that exact pretty much at the bearish CVD. So the fuel price 67 170, 67 170. So this is, yeah, this is at the bearish CVD, and this is an example of that thing. This is a repeatable pattern. I'm gonna go into depth more into this. This is just an example, a brief description of it. So this is the way I do trade the New York session. This is an explanation by Luxury, credit to him, and this is a very nice explanation which he has said. So characteristic of the New York session, some key times and setups and stats. Okay, so this is the same times that I just explained, but the stats behind this: 87.6% chance of taking out the London high at the low throughout the day. And pretty much knowing this, it makes you just want to wait for the New York, you know. So pretty much New York session highs and lows. I do trade swing failure patterns, structure changes, failed auctions, and these are the examples. So you do have an example like this one, which I just told you about, the New York sale program. That's an example. There we go. So that's the example. Vice versa, and that's the failed auction which I was talking about, anticipating the breakout, but then you do fail back in. In this scenario, okay, when you do like create a failed auction, you would kind of target the London low, which is also low of the day pretty much. And vice versa, this is a long setup. The first move down sweeps the London low and then continues up. So an example of trading view, how does this look like? So there you go. You have the bearish initial bounce, you have Asia coming down, London coming down, you do have New York coming up to take that high, the London high, and then you come back in. So pretty much you would look to fade that move up, and you would look for spikes in the volume and the open interest, and you would just enter as soon as that candle closes. This is the 15 minute. If we move to the 5 minutes, it's gonna get more clean. But yeah, you would just look for the swing failure pattern, and that's similar scenario to the one that I explained to you before. The first high is not the actual high. You have to look for high formed after the New York Stock Exchange open. So this is 235. So as I told you, so you would want to enter like this, and you would target the London low. So pretty much this trade would bring you 3.6 R clean. You would book that in. That's example number one. And let's see right here, similar scenario, right? You have Asia coming down, boom, as I told you, Asia, boom, London, bit of a range bound scenario. You do have New York coming actually to take that London low. Okay, so you do create a swing failure pattern. Okay, but this is at 230, yeah, and I told you look after 230. What happens after you take that low? you do create a bit of a, not an actual swing failure pattern, to be absolutely honest, not the most clean one, but if we move, let's say, into the 10-minute chart, maybe it's clean. It is a bit cleaner on the 15 minutes. No, not really. So it's not the most clean play, but that's why we do use the order flow, yeah? So pretty much this is the scenario which I'm talking about, this thing right here. So you can see spike in the volume, the most amount of volume on this flush, 9M, and you do have the delta, and you do have a lot of wrecked people. So this bar right here, this is the wrecked, e.g. liquidations. Coming back to trading view, this would look like this. You would wait actually for some kind of a push up. So let's say this candle right here, you would put your stop below that and you would target the London high. So that's 1.8. And then what do? You do sweep the London high. What happened over here? Why did we reject from that level? Why did we reject from that level? 67.3. Let's take a look at it. The range point of control. Failed rotation. What have I talked about failed rotation? If you do fail to rotate, e.g. reach the value area on the other end, in this case the VAR, if you do fail to reach that, it's a massive sign of weakness. And what did you do? You move down, and what did you take out? That big wick from a couple days ago. This is the Sunday low. Anyway, coming back into the model, most of the time you're gonna have a very key low or very key high being put in during New York. So if we move right here, okay, if we move right here, what do we see? Pretty much on the intraday chart, Asia range, London massive push up, then New York comes back to take out the London low and to taps into this naked session point of control. So very technical move. And then what do? You continue up. What was the low of the day? New York. What happens over here? What was the high of the day? New York. Here Asia pushes up, London is a bit of a range bound scenario, and then just New York flashes to pretty much test the Asia low. What is that high over here? New York. What does it sweep? The London and the Asia high, equal highs as well. Sweeps it, comes back in. What does it go to? Below the London low. So it's a very repeatable pattern. It is one of the best strategies you can use. I do call it the session shift. So yeah, just watch out for this thing. It's gonna make you money, I promise you, if you utilize it correctly. Cheers.